We would all like to reach our destination sooner if possible. In the world of investing, we want to accumulate wealth as quickly as possible so we can retire sooner. So are there some strategies we can deploy to our investment journey to make that happen? Let me share with you 5 in this video. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. I like to think of investing like a long road trip, driving for miles on the open road. And I like to think of the speed I'm driving at like investment returns. And any rest stop breaks or detours like my money not in the market, not working for me. If you're like me, a long-term buy and hold investor, we can't significantly control our investment returns. There are practical things we can do, such as cutting expenses by investing in low-cost index funds. But after that, we all need to follow the speed limit, the average market returns. But I feel the key culprit to people slowing down their journey to retiring sooner is the rest stop breaks and the detours we take during our road trip. We often intentionally or unintentionally have our money sitting on the sidelines, not working in the market, not growing, and not helping us to retire sooner. So let me share with you 5 strategies to ensure we aren't taking these breaks or detours on our road trip towards early retirement. The number one way we can ensure our dollar is working towards early retirement is to make sure we are reinvesting all dividends. A dividend is a reward, usually cash, that a company or a fund gives to shareholders on a per-share basis. When a stock or a fund that you own pays dividends, you can pocket the cash and use it as you would any other income. Or you can reinvest the dividends to buy more shares. Having a little extra cash in your hand is tempting, but reinvesting your dividends can really pay off in the long run, especially in your journey towards early retirement. For most index funds, when you initially set up purchase of securities, you'll be asked whether you want any dividends transferred to your settlement account or reinvested in more shares. My recommendation is to resist the temptation to transfer it to your settlement account and select reinvest to buy additional shares. This has a couple benefits. One is you have one less thing to do if you want to reinvest dividends. Your investment firm is doing this for you automatically. 2 is that you buy shares on a regular basis every time you get a dividend. This is dollar cost averaging, DCA, in action. I'll explain this concept more in a bit. 3 is that you're compounding your investment growth by continually adding more shares, which in turn will generate dividends of their own in the future. You're essentially supercharging your long-term returns through the power of compounding. Don't let your dividends pause at the rest stop. Get them back on the road immediately so they're working for you right away. The number 2 way we can ensure our dollar is working towards early retirement is to ensure we aren't trying to time the market. Subconsciously, we all do this to an extent. We say statements like, the market is up right now, so I'm going to wait until it dies down before I buy. My Tesla stock is down right now, but it should jump back up again soon. And when someone points out that we're timing the market, we often acknowledge that timing is not a smart move. But we also present all sorts of reasons why it makes sense in our specific situation. The bottom line is that if we're waiting to buy or sell until some point in the future, then we are timing the market. And I get into this wrinkle constantly. Though we have set up automatic investments on a regular basis, at times, I can't help myself but look at the market and consider the idea of delaying the purchase or making it sooner because I think the market is either overvalued or undervalued. Then my wife, who is much wiser than I, would need to kick some sense into me. Experts have long cautioned against trying to time the market. Financial journalist Jane Bryan Quinn observed, the Market Timers Hall of Fame is an empty room. When we try to time the market, we're making investment decisions based on emotion, not logic. And worst of all, we're keeping money out of the market, waiting at the rest stop. Focus on time in the market, not timing the market. In other words, don't wait at the rest stop trying to time the perfect traffic. Just get back on the road as soon as possible. The number 3 way we can ensure our dollar is working towards early retirement is to choose lump sum investing versus dollar cost averaging whenever we have a windfall. Dollar cost averaging, also known as DCA, is a phrase that refers to investing regular amounts over time, such as weekly, monthly, or quarterly, rather than investing all your money in a fund at once. Lump sum investing, on the other hand, is when you take all your available dollars to invest and put it right away into the stock market. If you have the money available, you don't spread it. You get it to work for you right away. It's the opposite of dollar cost averaging. Now, I'm generally a big fan of dollar cost averaging, and this is primarily due to the psychology behind investing. Most often, more than technical knowledge or specific insight, psychology plays a bigger role in our returns than what or how we invest. Benjamin Graham said it best. In the end, how your investments behave is much less important than how you behave. However, when we look at it from a pure analytical perspective, lump sum investing actually beats dollar cost averaging from investment returns. In Vanguard's 2020 research, they looked at the difference between dollar cost averaging and lump sum investing by assessing different stock to bond allocation in 3 different countries: the United States, United Kingdom, and Australia. It looked at rolling 10-year period from 1926 to 2011. They found that at the end of the 10-year period, the lump sum investment led to greater portfolio value approximately 2/3 of the time, even when results were adjusted for higher volatility of stock to bond allocation versus cash investments. And this result was consistent across all 3 markets. The study's recommendation was this: Invest a lump sum immediately to gain exposure to the market as soon as possible. And other studies have supported this finding as well. A similar study done by Northwestern Mutual, primarily in the US market, found similar results. They concluded that lump sum investing outperforms dollar cost averaging almost 75% of the time, regardless of asset allocation. In simple layman's terms, the bottom line is this. Because the market normally goes up, investing early produces higher returns in most situations. So if you can, lump sum and get your dollar to work as soon as possible. Again, don't wait at the rest stop. Get back on the road as soon as possible. The number 4 way we can ensure our dollar is working towards early retirement is to avoid analysis paralysis. And this is akin to someone just not investing or investing enough because they're overwhelmed with all the choices out there. Investing in general sounds and feels complicated. It conjures up images of complex mathematical formulas and really serious-looking people evaluating fancy charts on the computer screen. But it only sounds and feels complicated because the financial industry is working hard to make you feel that way. It's the ultimate financial marketing machine at work. And what happens to many of us is that we get so overwhelmed and never pull the trigger to investing in the market. And this can be detrimental to our wealth and our future retirement. If you're watching all these videos and you have yet to invest any money in the market, you're not being very generous to your future self. I guarantee you that when you're in the later stages of your life, you'll regret not having invested in the market sooner because you were scared. Having cash is good, but it will not build substantial wealth. It loses value over time due to inflation. In the road trip analogy, you're literally just hanging out at home afraid to get on the road. You want the market to work for you to compound your money over time, and the sooner you begin, the better. Here are some of my favorite equities index funds to start out with. If you're invested with Vanguard, the Vanguard Total Stock Market Index Fund, VTSAX. Vanguard 500 Index Fund, VFIAX. If you're invested with Fidelity, the Fidelity Total Market Index Fund, FSKAX. The Fidelity 500 Index Fund, FXAIX. And if you're invested with Charles Schwab, Schwab S&P 500 Index Fund, SWPPX. Schwab Total Stock Market Index Fund, SWTSX. All these funds are variations of the total market or the S&P 500 index, and all excellent equity funds to kick off your investing road trip. Don't linger around at home, start that journey. The number 5 way we can ensure our dollar is working towards early retirement is to not speed. And when I mean speeding in investing, I'm referring to either stock picking or trying to pick winning mutual funds, chasing better returns. Actively managed stock mutual funds are run by professional managers as opposed to index funds which are passively managed essentially by a computer. They are one of the most profitable investment products in the market. And when I say profitable, I mean for the companies that run them, not for individual investors like you and I. What's so fascinating about the mutual fund market is that there are actually more mutual funds out there than stocks. According to the US News & World Report, there are about 4,600 equity mutual funds operating in the US. Do you know how many total publicly traded companies are there in the US? Slightly over 4,000. Yes, that's right, there is more packaging of goods than the goods themselves. Pretty interesting if you think about it. But the sad fact is that very few of these actively managed mutual funds actually beat the index over time. In 2013, Vanguard studied over 1,500 actively managed equity funds over a 15-year period and found that 82% of funds failed to outperform the simple index. But actively managed mutual funds will never advertise that they have a horrible track record. They instead just bury the underperforming ones and launch new funds to entice new investors. When there's a lot of money to be made, especially for the investment firms, don't be surprised by how far they'll go to keep their highly profitable investment products selling. Don't speed. Don't try to find winning actively managed mutual funds or winning stocks in hopes that you'll get to your destination faster. Stick to the speed limit and just stay on the road. The bottom line is this. If you want to retire sooner, when it comes to investing, don't take breaks at the rest stop. Don't take detours. Don't delay your road trip. Don't speed, and simply just stay on the road. It may feel at times frustrating to just stick to the speed limit and stay on the road. But that is just what you need to do. Take what the market gives you through low-cost, broad market index funds, and you might be surprised by how quickly you get to your retirement destination. Thank you guys for watching. If you'd like to learn about some other ways to increase investment returns, please check out my video here. Until next time, all the best.